Welcome, you're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Robert Spinoza of RPM Mortgage. Now today's trivia theme is sports in the movies. So we'll have some fun with that.
Yeah, that'll be fun.
All right, let's see, Mark. You were going to start off with something.
Well, you and I last night had a great night. In fact, I'm still on a little bit of a high from that. We did a wonderful presentation at Piatti's in Mill Valley to about 75 people who showed up to listen to us talk about the Pacific Private Money Mortgage Pool Fund, and which in the last fiscal year has returned 8.5%. On a portfolio of loans with a weighted average of just 60% loan to value. So we've got a very, very conservative, it's a non-leveraged fund, so we don't use leverage to achieve those yields. It's 100% equity, and we achieved an 8.5% return, 8.25% for those taking monthly distributions, so you can either be a growth investor or an income investor in that Pacific Private Money Fund. And so last night's event was really cool because we had a bunch of people come in, as we said, and we talked about the fund, a little slide deck, and Edward and I had a great time. And what's really interesting is that most people who've heard of hard money, they think about how the hard money lending industry was, a lot of people say, oh yeah, I know hard money. You guys do seconds to like homeowners who are like in trouble and stuff like that. And that used to be, what hard money was. But really today, I don't even call it hard money anymore. It's really called, well, we call it private money. Hence my company, Pacific Private Money Loans. But because it's really a new industry, and in many ways, it is now the replacement for what used to be subprime lending.
Well, go ahead and give the example we were just talking about before the air, going on the air about how someone they have a mid 700 FICO score and yet they have a blemish.
Right. So really, the reason why, and I was kind of getting to that point, the reason we're the new subprime is because Dodd-Frank has actually been around for several years.
4-year anniversary.
Yeah, the 4-year, and over those 4 years, they regulations, and usually these new regulations were put in place in January of each year. So January of 12, January of 13, January of 14, there was these new additional layers of regulations they were putting on, really with the intent, among other things, to basically outlaw predatory lending and to prevent this stated income or ninja loans, as they used to call it, no income, no job.
No income, no asset, no job.
No income, no asset, no job. So, but really just to get away from the whole stated income thing and to make bank lending again, based on sound principles. Many will argue that it was a little bit overreaching. I happen to be one who believes that, but nonetheless, our business in our industry, private lending as an industry, is thriving today because thanks to Dodd-Frank and all the very stringent regulations. So we have example after example after example of people who really should be bank financeable, but they can't close with a bank loan. Either they can't close fast enough, or they can't close at all because, well, for example, the woman who came to me, I got a frantic call last night. They got to close by Friday, right? And so very, very short period. She's got a mid 700 FICO score. She owns a bunch of real estate. She has very little debt, low credit card debt. I mean, she's got great credit and she's got good assets. But she tried to modify a couple of her bank loans 4 years ago, and she was disqualified.
See, and I got to think that the banks are saying, well, if you try to do a modification, then what's to stop you from trying to modify our loan if you get into trouble?
I thought you were going down the path of saying she had financing on too many properties, because that's another thing lenders will take.
Well, this was a commercial property that she's buying too. That's the other thing. So it's a commercial bank loan application on commercial property, 6 units, and she has a strong portfolio of income properties. So she's a real estate investor with a lot of experience. But going back to homeowners, we've also done a number of loans now for homeowners who were in contract, maybe a 30 or 45-day contract, believed they were going to get bank financing, and then, as the clock was ticking and you're getting down to the last week, discovered that either the bank could not close in time because maybe there were difficulties with the application, or they were digging. Sometimes you send them information and then they want
reveals
more.
Other things.
It reveals other things, right? So again, this is not to say that and Rob, you're a conventional mortgage loan originator with RPM Mortgage, and we'll talk a little bit about this during the show today. But I think there are things probably people can do and should do to confirm that they can actually get
Right,
bank
right.
financing, and because otherwise you're going to end up at the doorsteps of someone like me at the last minute with an unexpected additional cost to get that property.
Right.
Maybe you'll have to use us for what we call the short-term bridge loan that we're doing. We're probably doing 15 of those transactions this month alone in July. Short-term
I've
bridge
seen a lot of
loans.
that.
Yeah, but you're not the Grim Reaper. I mean, you
Well,
make it
no,
sound
no,
like they
it's
probably
not horrible.
that you
Well,
have
But
to
if
come
you
to
were
us,
expecting 4.5% and then it
Yeah.
deviates from that,
At one point, right?
Right.
We're our typical bridge loan, which is basically a rescue me loan, which sometimes has to be done in just a few days. We charge generally 9.9%, and the payments are interest only because it's a short-term loan. You can pay us back whenever you want, no prepayment penalty. And the points are usually between 2 and 3, which that's usually the sticker shock for
Right.
for
Yeah.
people. They think, oh my God, 3 points, really? But when you think about it, that's kind of our business model. I survive on points, and my investors, the lenders who supply their capital to me, they get the note rate, and that's kind of the quid pro quo
Right.
of how our business model works. So I can't, I'm not like B of A or Wells or the other guys
where
that
you're
can
going to
go.
be holding loan and
where-
securitizing it or anything else.
Yeah, or where I can go to the overnight Fed window and borrow
Right.
at 0.5%. See, I can't get money that cheap. I'm using private capital, and
Yeah.
I'm able to pay out to my investors after expenses
Right.
8.5%. So they're thrilled. I have a business that works, and we're here as a last minute resort for a lot of
Solutions-based
people.
lending.
Yeah.
I do want to challenge you on one thing about the subprime, though. A lot of subprime loans were made at very high loan to values. And that
yeah,
was,
yeah.
and that to a large degree in my mind preceded the downturn, because when you have
Yeah.
high loan to value and you have borrowers who may not be able to support the debt, like Mark mentioned, they may have been stating their income, so they were really counting on a refinance with an improved value down the road to get them out of the situation they couldn't support to begin with.
Ah, yes.
Mark's model and the private money model that's in place now differs from that greatly, because there are conservative loan to values. They're not interested in making a loan at 90 or 100% of the
Sure.
value of the property.
That's right.
And therefore, the investor in that note has a security on the value itself. It's unlikely, I would think, this is your business, but somebody's not walking at 50% LTV.
Yeah, but
They're-
don't use the term subprime. though, 'cause
I'm
that
still
has a
trying to
bad
come up with a
stigma.
better name. If
No,
you
no,
guys
it-
can think of one, please let me know,
and
because we're
Super loans. How's that?
No, I think
super
that-
prime. No, but it's
Super-
not. It's not.
All day.
Prime,
Yeah, I mean-
prime loans are from the banks,
Right.
and non-prime. Some of them call them just calling them non-prime loans. It's essentially, if you can't get bank financing, at least the good news is there's a
Non-conventional.
thriving private, non-conventional, private-based lending industry that's out there to help you. It's just, unfortunately, it's a pretty big spread in terms of origination fee costs and note rate.
Well,
But the-
that's because subprime doesn't exist, and I think
doesn't
that
exist,
if
that's
it were
right.
if it were underwritten properly and people understood, if there were a way to have prevented subprime from becoming the Wild West, we would have had a very viable middle ground program. And what's interesting about that, Mark, is that how you have benefited from Dodd-Frank's restriction of exactly that.
Yeah.
So by protecting the consumer from a middle ground between private money and conventional money, they forced all those people over to private. Interesting.
Maybe when we come back, Rob, you can talk a little bit about what you're coaching your conventional borrower applicants on how they can improve the
Absolutely.
probability of closing.
That's a good idea. I mean, I went to my bank and asked for a subprime, and they said, "What?" And I said, "Well, I want a loan lower than prime rate. That's subprime, isn't it?" No, could do. Okay, here we go. Here's our first commercial break. Trivia question. Sports in the movies is the theme. What was the name of Rocky Balboa's dog in the first Rocky movie? Okay?
Oh, I know this.
All right.
Okay.
The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. Answer this question. What was the name of Rocky Balboa's dog in the first Rocky movie? That's a sports movie, right?
Yeah, it is.
Okay. Don't touch that dial.
Mark's taking notes.
Yes.
Be careful.
Don't touch that dial. The best of investing. We'll be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Rob Spinoza of RPM Mortgage. When we get to the first commercial break, we ask this trivia question. Again, the theme is sports in the movies. What was the name of Rocky Balboa's dog in the first Rocky movie?
Was it Snuffy?
No, Snuffy. Yeah.
Yo Butkus.
Yo Butkus.
Ah, that's right.
Hey Yo Butkus. That's right. Very good. Okay, Butkus actually, not Hey Yo Butkus,
Yes.
but
Who is Butkus?
Who is Butkus? Jeopardy. Yes, Alan Trebek. Okay, Mark. Why don't you continue on?
So we were talking about in the last segment about how the private money lending industry has stepped in over the last 5 years to really take, to fill up that void left by all the banks that were doing subprime loans, and of course now all of a sudden subprime is no longer legal. And with the passage of the Dodd-Frank reforms, of which like the last layer, hopefully the last layer, went in January of 2014, which essentially outlawed things like stated income loans, making loans to people who don't have a demonstrable ability to repay, meaning they don't have actual income, and on. And there's more, layers that they've added on, but not to get completely boring, but
toxic features.
Those people who are in the midst of either they're in escrow or soon to be in escrow, or they're looking for a house or they're house hunting, they really need to be aware that conventional financing is more difficult to, but certainly not impossible to get today. And so you've been Rob Spinoza, mortgage loan originator for a number of years, through thick and thin, through the easy days, to the super hard days, and now through the days where we're reacting to Dodd-Frank. So how are you coaching your clients to help them make sure they don't end up having to come to someone like me? Thank you very much, but also I've got a heart too. I'm not. Well, I like the lion here.
You were eating pork and beans. You were eating lobster. What are you eating now? That'll tell me how good the business is.
All diet considerations aside, what I guess the best coaching advice I can give any client is you've got to be prepared to fully document everything that is going to go into your loan application. So income, assets, and credit are the components, and they are very, they're encompassing. They take into consideration just about everything in your financial profile.
Well, let me ask you about that. How about stories? I mean, can you explain away certain things?
Letters of explanation are involved in almost every file nowadays, believe it or not. Now, they really are going to bolster a case. They're not going to make or break a hard and fast guideline. That's been my experience. So let's say, for example, you've got a declining income trend. So the borrower earned, they're a commission employee, let's say. They earned more in 2012 than they did in 2013. You're going to need a letter of explanation to say to an underwriter, this was the reason for that decline. That is the difference between an approval and a decline. So to your point, yes, I mean, you can explain things away, but they are looking for a reason to make that loan. It's very hard to say, I had a foreclosure in 2012, but I really didn't want to. The bank maybe. That's not going to work. You have a guideline there that.
Or the reason my tax return is lower is because I embezzled from my employer and I didn't want to report it because they catch it.
Well, because that's the one you saw, not the one I filed.
Or whatever. What I hear from applicants is, I make more money, I just don't report it all.
Yeah,
right.
That's
so Mark, that's exactly the point. So when you go into the loan process, for example, let's say even you're a W-2 employee and you earn a certain salary, know that the lender is also going to look if you have unreimbursed business expenses on your tax return, on the Form 2106. So they're also, nowadays, they're going to that level of scrutiny on things. And
so they actually understand tax returns nowadays?
Yes.
They didn't used to.
Yeah, it didn't matter, because if the deal didn't work, you would send it to, like Mark said, you'd send it to a stated income lender, and then they didn't look at the return. But now you can't get around that. So the advice I give to a client is, know that the process can be invasive. Be prepared to document everything. And if there's anything you're not telling me, we're going to find out. Let's know that now, as opposed to 30 days into the escrow when your deposit is at risk and you have a lot to lose.
Yeah. So let me ask you a question. So here's an example of a file that ended up on my lap that should have been conventional. Self-employed borrower has a lot of bank accounts, some of them in some of his DBA names, and he moves money around. And that was
tough.
And the mortgage loan originator who sent it to me said, I can't get the guy to stop moving his money around because he's got an active business, and my lender keeps sending the file back. What do you do in a case like, how do you coach your client to behave when he's self-employed and maybe has multiple bank accounts and yet he's applying for a home loan?
Yeah, in this case, the best advice you could give them is you could say, what account do you use least? Okay, and then you'd make a deposit into that account and you would leave it there for 2 months. So that would be your down payment funds and your closing costs, because you're going to be required to document 2 months of statements. Okay,
it's 2 months now.
2 months, hard and fast. You're going to need any deposits to go into that account that would be considered quote unquote large deposits. So generally a significant portion of your gross monthly income. They're going to ask where it came from, and if it came from a business or if it was moved around, then they're going to go back to the source account and say, okay, what's in that account? And this guy's getting himself into he's chasing his tail, and it gets very difficult because what happens is every time they go back around, the pressure is greater because you're further into the escrow. So that's the deal with that. You've got to quiet your accounts. You've got to have the money seasoned in there.
I a question for you, Mark. You're kind of teasing about these people who come to you and say, well, I really make more income, but I just didn't report it. And I'm thinking, okay, according to a couple of presidents ago, character doesn't matter. So, but it does matter with you.
It does. I am not happy when I hear those. I mean, quite frankly, because I pay a ton of taxes, and I know you do too. In fact, all three of us here. I report every dime of income I make, and I'm proud to do so. It's we're fortunate to live in this country, and it's
taxes are the price we pay for civilization.
Absolutely. So
give Caesar his due.
And I'll tell you what even makes me angrier if they're not someone who was born in this country and came here to take advantage of our great nation and capitalism, and they're not reporting all their income. That really irks me. So I'm not a fan. I typically, send those guys off, to somebody else when they.
You don't say ordinarily we charge 3 points, but for you 25 points.
Right. No, I just I try not to be rude to people, but quite frankly, that is like a non-starter.
That's the name of the game with
conventional lending. And then they take the
lending.
income and they send it to another country too, so it takes it out of our system.
The income I don't report, I send home to mom and dad.
Well, that's a good one, all right.
Yeah.
Okay, tell you what, Rob, we have an email here. It says for you.
Yeah.
It says, what can I do if my appraisal comes in too low? That's a really good question.
It's a great question, and believe it or not, the answer confuses even seasoned professionals in real estate because it can get confusing when you start involving the lending guidelines. I'm going to assume for a second this person is buying a house, but it applies if you're refinancing too.
Well, yeah, because especially with multiple
Right.
offers.
So
I mean, it's like, what's the poor appraisers nowadays?
Right, so
Exactly.
you're pushing the price up with your bids, and now all of a sudden the appraisal doesn't support where you ended up getting accepted at.
Yeah.
What happens? Okay, so the lender uses the lesser of the purchase price or appraised value. And that's the key concept to remember. Lesser of purchase price or appraised value. So let's take an example where you've got a $500,000 purchase price. The answer to what happens if my appraisal comes in low depends on where your loan to value is.
Okay.
If you, let's say $500,000 purchase price and you're putting 20% down, now you have a $400,000 loan.
Yes.
Okay. That's if the purchase price is $500,000 and the appraisal is $500,000. If you got a calculator here, you can.
Go ahead. I'm listening.
Now let's say the appraisal comes in at $475 and not $500.
All right. So now
Your loan to value
is 84.21052%.
And what happens at 84% loan to value? You now have private mortgage
Mortgage
insurance,
insurance.
or you have to take a second mortgage.
Oh.
So, in that case, the fundamentals of your financing would have changed because the appraisal came in low. If, however,
They could just put up more cash if you have it.
and so,
Okay.
yeah, one of two things will happen. Either you will renegotiate with the seller and say, look, we're willing to pay what the house appraises for, and they may or may not accept that. And the second thing is, in addition to the $100,000 you plan to bring in as your 20%, you're now going to have to bring in $125,000.
Yeah.
Okay? If your loan to value was originally set at 50% of the purchase price, now you're getting a $250,000 loan. If it comes in at $475,000, your loan to value is probably 53% or 54%, right?
52.6315.7%. I did that in my head.
Wow. And
not really.
there would be no change to your terms or your guidelines at 53% versus 50%, so you see no difference.
And you kind of wonder too, with the appraisers, how they would come in at values less than what the purchase price is. And I guess if you get so crazy overbidding,
Right.
that's really what it is.
They have
'Cause
the-
otherwise, it's willing buyer, willing seller.
Yeah, and they have their work cut out
Absolutely.
for them, and when it starts to get grossly overbid, what happens is they have a hard time finding comps that support the price per square foot. So that's what's going on there.
Okay, we're going to cut to our second commercial break. When we come back, we have an email from Mark that talks about the cost of a commitment letter, which is, I'm sure, a very common question. All right, here's the second commercial break. Trivia question again. This theme is sports in the movies. Where did Coach Herman Boone take his high school football team for a 2-week training camp in the movie Remember the Titans? Remember that? Remember the Titans? Okay, the first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. In the movie Remember the Titans, Where did Coach Herman Boone, if you remember Denzel Washington played him, where did he take his high school football team, for a 2-week training camp in the movie? A little esoteric type questions there. All right, don't touch that dial, because when we come back, we're going to give you the answer, and then we're going to get into that email with Mark. Well, welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we cut to the second commercial break, we asked this trivia question. The theme is sports in the movies. Where did Coach Herman Boone take his high school football team for a 2-week training camp in the movie Remember the Titans? You're shaking your head.
I don't know.
You stumped the stars.
Gettysburg, Pennsylvania. You ever see the movie?
No.
Didn't.
Oh, well, it doesn't help if you didn't see the movie.
Yeah, I didn't even know Denzel Washington was in it. So
But you know who he is.
Yeah.
Okay. it was basically it was a black versus white type thing, and so he had them on a big run to go, and then finally to explain about how all people died there for trying to do race relation.
That's pretty neat.
It was an awesome movie.
Yeah, I heard that though. It was a great movie.
Okay. So Mark, we have this question for you. What would it cost me to get a commitment from you to fund a loan? I mean, I might want the loan, but I might be able to get bank financing.
Well, the answer on that really depends, because first of all, it's not the Wild West anymore in hard money, which again, I tend to refer to it as private money loans. We're regulated now, just like everybody else in mortgage loan origination. So the answer is we're not allowed to take or charge an upfront fee on a loan that we would make secured by a residential 1-unit through 4-unit properties. We refer to it as Res 1 through 4, residential 1 through 4 property. That's considered, 4 units and less is considered residential property under, and there's certain set of rules that apply to any property that falls within that 1 through 4 units. And so,
and non-occupancy doesn't get you out of that.
No, it doesn't.
Okay.
Even if it's for investment purposes, we're not allowed, according to the regulations, to charge fees up front. Now, we can collect a fee for pulling a credit report.
Right.
We can collect a fee for ordering an appraisal. But it's against regulations to charge for a commitment fee or an application fee.
Right.
Now, that's not to say that some people in this industry don't still do that, because they probably do. There are a lot of guys out there playing in this arena of hard money / private money, and they're under the radar, and they don't go to any of the industry events, and they don't use attorneys to keep them compliant with today's regulations.
But then how do you protect yourself from doing all this work and then suddenly being left at the altar, as they say?
Well, the answer is very simple. We employ the use of a fee agreement. So we don't use it all the time, because again, a lot of the stuff we do gets referred to us from people who we know and trust, or sometimes I'll just have a conversation with the applicant and I can kind of tell they're not shopping, and I'm just going to go with my gut on it. And so I don't always get a fee agreement, but there are lenders out there that, as a course of business, after a conversation and accepting an application, they will include with the application a fee agreement that basically says, hey, if I get you this loan that I'm within the ranges of the quotes that I'm getting you, you promise to pay me a fee. And we have had a lot of deals this year. I mean, I would probably say maybe a dozen loans where we got as far as loan documents, even on a couple of deals where our lender actually even wired the money to the title company.
Wow.
And the borrower backed out last minute. And on one of those we had a fee agreement, one of those we didn't. The challenge is, though, to go after someone on a fee agreement also costs legal fees, so it has to be a sizable enough amount to make it worthwhile.
Do small claims, or at least.
Yeah, that's true. So again,
it's pretty simple. I mean, if you have the fee agreement, it's kind of black and white.
But at the end of the day, you're in the business of making money, making loans, not collecting fee agreements.
Well,
and that's what you have to really weigh.
Look, what I say is I believe in having a focused business where we do a certain amount of volume per month. We're looking to do 25 to 30 loan transactions per month. I am not going to get distracted by
Exactly.
the one or two deals
said.
that spin out of
Yeah,
control.
that's true.
Look, I operate with integrity, transparency,
Yeah.
and accountability, and I can't help it if every now and again there's going to be people in this world who don't operate from that viewpoint,
Yeah.
and they will do and say anything to get what they need.
And look, if the guy's not going to uphold the fee agreement, you're glad you don't have him as a customer.
Well, that's
Well, yeah,
exactly
you
right.
know,
So,
you mean that,
so quite frankly, so time's too short to really get caught up in that. At the end of the day, most people are honest and have
Yeah.
integrity, and when
Yeah.
they approach us and we tell them, hey, this is exactly what I can do, and we've got a 100% success rate, and I mean it when I say we have never left a borrower at the altar once we've green-lighted a deal. If we said we can do this and we can close when you need us to close, whether it's 3 days, 5 days, 7 days, we perform, and that's why we've got a good reputation. That's why people call us.
Kind of curious because you said you do roughly 25 plus deals a month.
Mhm,
That's
yeah.
for all intents and purposes a deal a day.
Yes, absolutely.
How do you close a deal a day? I mean, obviously.
Well, they
you're
all
not
happen on
getting-
Friday. Let's get that straight.
Okay, yeah, good point.
Well, it takes a village, right? It takes a team.
Yeah.
It's a village.
We've got a team of 5 people in our underwriting and documentation office, and so I've got 4 agents, and all told, there's 12 of us at Pacific Private Money, and so we're not a huge operation, but we're not a small
But
operation.
if you
so-
get your escrow officer on board too and stuff like that.
Yeah, we're
that
just,
helps a lot.
again,
Yeah.
we've got very controlled operating procedures that we
Right.
go under, and we're not the only office in town doing that volume. We're in the top 5 in the Bay Area, I believe, although
Good for you
most of
guys.
us are, I mean, I don't think there's any publicly held private lenders, so it's really not public information, but we kind of know who the players are. I know who my competition is, and I know who my competition isn't. So when somebody calls me and says, well, I got a quote from this guy, I might have to stifle a cough and are you kidding? That guy will never deliver at that price, and he's not going to close
Yeah.
even if he could. So.
It's interesting. I just ran into somebody who said that Oakland, and it's a little change of subject here, but
Sure.
Oakland, some of the prices went up like 300 or 400% in the last couple of years.
Home
Yes.
prices.
Home prices, yeah.
And
In some areas, I believe that.
Yeah.
I have a buyer that bought a home in Oakland, and their timing was perfect. I think they paid around $600, and I was looking at a refi opportunity for them. I pulled them up on Zillow just out of curiosity. Said the property's worth over $1 million.
Yeah.
Oakland,
So,
certain
yeah.
neighborhoods in Oakland are like certain neighborhoods throughout the Bay Area and California that experienced a huge increase in the run-up between 2000 and 2007. Then they went way down.
down,
They were
yeah.
among the markets that went down as much as 60. I even saw examples of some homes that had an 80% drop
Wow.
in valuation,
Yeah.
although I'm going to tell you that the valuation at the high was never real to begin with, so it was a false valuation, but there was, in some market, it was just ridiculous how far they dropped. So it doesn't surprise me, again, that those same markets that I think probably went too far down have now come back up. in a big
Oakland
way.
also suffers from a piling on effect, and other areas in California are like this too, where when the market went down, it was coupled with the fact that it was Oakland, rightly or
Sure,
wrongly
sure.
so, and then
Yeah.
that added to the
Like Stockton and all that.
Stockton's right in there.
And
Yeah.
before I forget, also, and we'll get back to you
Yeah, no
Mark, for a
problem.
minute. Mark, how do people get a hold of you if they wanted a loan without a
So
credit fee?
we serve a couple of different clients. We have clients who come to us who need money, and they need money fast. Whether you're a mortgage loan agent or a realtor, and one of your clients is in trouble and needs to close quickly, or you're a borrower and or a real estate investor, and you want a reliable source of financing, we're the company to call. The second type of client we serve is if you have money to invest and you're looking for investment alternatives, and you're upset about the yields that maybe you've been earning at the bank or in bonds, or maybe you're thinking the stock market might be a little bit overpriced right now, and the idea of earning 8% or more on your money is intriguing. In either case, if you need money or you have money to invest, give us a look, give us a call, Pacific.
In the movie Major League, who does Jake Taylor imitate at the end of the game to fake out the other team's third baseman? If you didn't see the movie, it's not going to help. If you saw the movie, you should know this. All right, don't touch that dial, because when the Best of Investing comes back, I've got a very interesting article about the 7 deadly sins of business credit reports. Don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host last time here on the show for the night. Mark Humph is my co-host.
Good night and good luck. No, not yet. Don't go.
Not yet. And Rob Spinoza of RPM Mortgage. Third trivia question, commercial break question, excuse me. Sports in the movies. Who was Jake Taylor imitating at the end of the game to fake out the other team's third baseman in the movie Major League?
I saw the movie.
Saw
It was
the
so
movie?
many years ago. I can't remember that scene.
Okay. Babe Ruth. Because he points to center field, calling the famous shot, and then he fakes it out by doing a bunt.
I batted 1 for 3. That gets me into the Hall of Fame, right?
That's true. And you know the difference between batting 250 and 300, which would get you is one hit a week.
A week.
That's amazing.
Just one extra hit a week, and look how hard it is. Okay, I promised the audience. I can't leave them in suspenders all the time. The 7 deadly sins of business credit reports. This was an article that I read somewhere. It says, and this would really kind of attest more for Rob here, is old or not live data. Okay, that's number 1 here. Primary purpose of credit reports is to provide useful quality business information.
Right.
So if it's old or inaccurate, it's got no value. Bias data. It says, let's assume you found a provider that offers you live reports. Do you know where the data comes from on the reports? Some providers offer self-reporting services that allow companies to submit their own company's payables to help build or inflate the credit report.
Oh, okay.
Nice.
Yeah.
Pay per report or expensive packages. And so now, there's a free website.
Yeah, annual credit report.
Annual credit. Okay.
It doesn't give you your FICO score, but it gives you your credit. It gives you your credit history.
Okay.
Yeah.
And you can, if you've got really good credit, you can pretty much
Derive
guess
that from that.
Right. Exactly. Poor quality or expensive internationals. In a growing global economy where the world seems to be getting smaller by the day, doing business internationally should not be the risk or high cost it once was. For most companies, extending credit to their international customers
Right.
is just too much of a risk.
Wow.
Okay, poor search function. One of the things that we would expect from credit report provider is that the database would at least contain a report on a current or prospective customer. Finding information on a business can be very frustrating at times. Okay, so there's a lot that just can't search things correctly.
Interesting, the whole business credit in terms of being able to borrow money on a kind of a business level as opposed to a personal level has really exploded in the last 12 months. I mean, there's a whole bunch of new startup companies that I've been reading about in many of the business sections, talking about companies, and I can't name any offhand because I didn't bring anything in, but just your article there reminded me of that. But the thing is the money is so expensive. I mean, people think that, my money, Pacific Private Money, is expensive at 10%. I mean, try doing any kind of business loan, even from like a lending club or something like that on the web, and they're borrowing, they make it easy to borrow $5, $10, maybe $15 or $20,000, depending on, your credit history or whatever shows up for your company. But you're going to pay like credit card rates for that money.
Oh, yeah.
Anywhere from
I know
15 to
very
30%.
little about that.
Yeah,
I don't know anything about it.
don't you love you get these faxes? That they fax you.
You still
a
get
check.
faxes?
I still have 2 tin
I
cans
don't
and
even
a
have a
string.
fax machine anymore.
When my wife calls me, we have the 2 tin cans and a string. It's a very long string. But yes, I still get faxes. Thank you very much. I'm just a little old here, but they fax you.
He's got a rotary telephone on his desk here, too.
right,
You
exactly.
viewers at home.
I got a little squirrel with a hammer and a chisel on a Flintstone tablet. So they fax you a copy of a check with your name on it, and you can have $50,000 and et cetera, et
Well,
cetera.
you get those in the mail now too. And it
Hey,
just says non-negotiable, but
you get mail. Well, okay. And speaking of non-negotiable, which I love this, I told the story many months ago, but so I got to repeat it because it's funny. I had an old secretary one time who her boyfriend once was taking her out to lunch, and he said, "Oh, by the way, before we go to lunch, I got to stop by the bank. I got to cash this check." And she said, "Oh, she's kind of curious. Well, what's the check?" He goes, "Well, it's $25,000." Whoa, $25,000! I mean, the guy made probably $8 an hour on his job, and he says, well, "I don't get it. Where did this check come from?" And she goes, "Oh," he goes, "Oh, I got it in the mail." And sure enough, she looks and goes, "Wait a minute, let me take a look at this." And she looks at it, and sure enough, on the check it says non-negotiable, right? And so she says, she goes, "This says non-negotiable, don't you?" And he says, "Yeah." And she's going, "Wait a minute, something's not going in the synapses here." She goes, so she asks him, she says, "Do you know what non-negotiable means?" He says, yeah, it means you can't negotiate.
Yeah.
It's 25,000. It's not 40,000. It's not 100,000. It's 25,000, and that's it.
I think it was John Wayne said,
it were
"Life."
only so.
Yeah, John Wayne said, "Life is tough, and it's tougher if you're stupid."
Okay.
Wow.
We got a couple of minutes left, guys. Any fun stuff to talk about?
Well, Rob and I both, doing a little pre-radio show research here, both saw the same article on foreclosure activity and the fact that it's hit the lowest level since before the housing bust. And I actually saw it in the form of a graph, and so the level of activity, looking at the graph, is basically back down to where it was the levels before. The housing bust. So, but what's interesting is, what does that really mean? I mean,
Yeah.
so foreclosure activity is down, but there's still over 1 million homes in California that are underwater, and there's still people in distress in real estate. So it doesn't mean that we're in the clear.
Wait a minute. You still get graphs?
Yeah.
I'm sorry.
This
I
could
still
go on.
study
This
charts
is
and
going for
graphs.
a really long time.
We got to wrap this up because my horse is hitched downstairs. What I was going to say about that is the other thing about appreciating values is they impart a lot of hope. And I think if you're going down the road of foreclosure, a lot of these stats reflect what, if we remember back to 2008, 2009, some people threw in the towel right away. They're like, hey,
some people stopped opening up their Schwab statements.
Yeah.
I don't even want to look at it. 'Cause I know it's down.
And so when that happens, I mean, look, if they come take me out of this place, so be it. I'm going to put my keys in the mail. We heard all these things.
Yeah.
But now, if you think, hey, this house might be worth what I paid for it, a few years ago, or in a year or two, it maybe.
Right.
Now you're not willing, I think, to make such a rash decision if that's what the difference in these stats might be, or partly be. So I think it reflects some of that. I think that's in there too.
That reminded me that there was a time when I had this building and it went way below what the loan was on it.
Mm-hmm.
And I was talking to my other banker, so not the one who actually had the loan. And I said, what do you think if I were to just talk to him about, talk to this other bank about,
Right.
renegotiating? Yeah, just it's can you knock some principal off? And he said, don't do it. He said, because it is going to affect the kind of business you have with us. And,
I
and our
see.
stuff is very important with you, as you can imagine. I said,
Right.
oh, yes, it is. And he said, we've actually had people who got a loan modification, whatever, put the loan back on.
Okay.
They actually, and it was up to like $500,000 extra.
Yeah.
That they had basically said, okay, forget about that. I don't want the $500,000 because I guess they were dealing in millions of dollars on other stuff, and they didn't want to mess up their credit.
Well, the good news is that foreclosures are down, but I think that doesn't mean to say that there's still not a lot of people who are not making their loan
Yeah,
payments.
I'm
It
sure
just means
that's
the
true.
banks aren't foreclosing, and so that's very interesting.
Because is the economy really getting better? No,
Well,
some people are getting jobs.
Well, time marches on though, and I think that's one of the things we're learning. I mean, the Fed is hell bent on ending its bond buying, and by October they're talking about raising rates in next year. But yet there's a lot of market fundamentals that don't support those things, and we'll see how the economy responds when that happens, when and if it happens. It's going to be interesting to see. And I also think that a lot of Mark is right, a lot of the foreclosure, a lot of the short sale activity, a lot of the distressed homeowners are still out there. But maybe, with the change in market dynamics, they're taking a different approach. They're not as obvious.
Yeah, absolutely.
Well, again, we had a very successful last night seminar.
great. Yeah,
40 people showed up.
Piatti's in Mill Valley. It was awesome, and had good food and some wine. And so we're going to do another one in 2 months, and we'll announce it. We'll get. People
I'd be
on the
curious
list.
to know with the yields in the stock market up. I mean, I look at a lot of bank statements. I look at a lot of retirement account statements, and you see the yields on these now 7%, 9%, 8%. Is that affecting your business? I mean, do you see that people saying, okay, I can just earn this on a safer investment now, or are they?
No,
looking
not
for
at
that?
all. I'm not
Good.
getting that kind of pushback at all. In fact, I mean, I know that there's certain REITs and other things that can produce that kind of yield, but they're not in terms of the stability and solid nature.
You still have principal risk.
Right,
Yeah, absolutely.
right.
Okay, guys, we're going to cut out here. Here's our thoughts for the day. Dr. Ruth. Remember her?
I do.
Yeah.
Always wear a condom. Remember her? Okay. Dr. Ruth was trained as a sniper by the Israeli military.
Is this like one of those Mr. Rogers ones? I did figure that out. That wasn't true.
That wasn't
that
true.
was a great
Mr.
story
Rogers?
now that he was.
But there was a catcher named Mo Berg who played with Babe Ruth and all that, and they sent him overseas, and he really was he was like 12 languages and all that kind of fun stuff.
Interesting.
So yeah, I thought that was kind of interesting. Okay, and in the early stage version of The Wizard of Oz, Dorothy's faithful companion Toto was replaced by a cow named Imogene. Now, can you imagine getting a cow in that hot air balloon? No wonder she couldn't get back to Kansas. All right, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Answer this question. What was the phrase that Ralph's mother and Santa Claus used to try to discourage Ralph about getting a Red Ryder BB gun? Which, by the way, I just bought one myself.
For yourself?
Yeah.
For fun, or
Yeah,
is it for,
yeah.
all right.
Yeah, because sometimes the kids need a little bit of, you can't spank any anymore. So you gotta shoot with the BB gun.
Okay, yes.
Just kidding, audience. Okay, make sure to leave your name and your email address. Speak slowly, spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm the old fart Edward Brown.
Stop it.
We were just teasing that off there. I'm Edward Brown, your host, along with Mark
Who's
Hahn.
the young part?
She's not a fart. She's a very nice co-host.
The young arch.
That's it. We got Mark.
Yeah.
In this corner here, we have Mark Hahn, president of Pacific Private Money.
Indeed.
In the middle corner here, we
In the middle corner.
We have Catherine Harris of Karate and Garage. She's a CPA, and that stands for Certified Public Accountant. For all you people out there who don't know that. And Robert Schiff of RPM Mortgage. He's a mortgage broker. Okay, when we cut to the second commercial break, and we're not drunk on tryptophan here from our Thanksgiving turkeys. We're just acting a little goofy. Okay, here is the trivia question. Again, the theme is the movie A Christmas Story movie. What was the phrase Ralph's mother and Santa Claus used to try to discourage Ralph about getting a Red Ryder BB gun? Mark?
I don't know the answer to that. Is it how to be back?
I'll be back. No, that was Arnold from Terminator. Does anyone else know? What was the?
I don't know. Is it the one that'll poke your eye out?
You'll shoot your eye out.
Oh, there you go.
Catherine,
Close enough.
Close enough. That counts. 2 for 2.
Finally.
Finally. Yeah, we give her something from the 1970s. It's all over. The 80s is okay. Okay, Mark. Trivia. Question we got.
Truth or dare?
Truth or dare. We got an email question for you here. My bank just turned me down for a loan, and I'm thinking of calling you, but I want to know: are you going to make me get a new appraisal, or can you accept the one that I already have?
So when they say you, meaning, if the bank turned me down, so I'm thinking about going for a hard money or a private money.
Correct.
So the answer, will we make you get a new appraisal? Usually not. And so we're not required, because at Pacific Private Money, as with other hard money lenders, we're generally not in the consumer home loan business. So I'm guessing that person who wrote that email is looking to buy investment property. So with investment property, if it's a business or investment purpose, we're not under the same regulations that would require us to order our own appraisal. So that's really for the consumer home loan business. If you're buying a primary residence, they have this whole new set of guidelines in terms of more appraisals and certifications. And
Everything.
Everything, yeah. It's a night and day difference. Now, although I will tell you that even the hard money lending industry is a lot more regulated today than it was, say, 5 years ago. But in terms of appraisals, in fact, one of the regulations coming down the pike, and we're still kind of reading the legislation to make sure that it does in fact cover business purpose on purchases of residential property. We're not really sure yet how that's going to be interpreted, but we may be in a position where we have to order appraisals if you don't provide one. So there is the whole do we or do we not need to, because one of the things about hard money in prior years was that we didn't have to order an appraisal. In fact, we've done a lot of purchase transactions where we just reviewed the transaction and the documents and did not even require an appraisal on the purchase side because, quite frankly, my personal opinion is it's usually redundant. It's silly. It always comes in at the purchase price, right? You've got an arm's length transaction with a listing agent and a buyer's agent, and
I mean, what's the appraiser gonna come?
Right, I know. So the purchase price is $400,000 for a Bay Area property. I mean, really, is it going to come in more? Is it going to come in less? It's probably neither. It's going to come right in at $400,000 because it's an arm's length transaction
Well,
between
it's
a buyer
probably
and
not going
seller.
to come. I don't think the appraiser was going to risk saying it's worth more,
Well,
right? I
That
mean,
does
that's-
occasionally
that's-
it
pretty
does
rare.
occur. We're funding a loan at Pacific Private Money where it was a probate acquisition that was such a great deal that we got it independently appraised, and it came in $50,000 higher than that, which surprised me because again, normally the appraisers are
And
not.
they know what the purchase price. Did the appraiser know what the purchase price
They
was?
did, yeah.
Wow.
Yeah,
Do they
so-
generally know that
They
before
gen-
Yes,
Well,
they
yeah, they'll always
generally want to
ask.
see a contract or
Before,
at least.
Although I'll tell you, when I order appraisals nowadays, I won't show them because I
Yeah.
want them to independently
Talk about
tell me.
Yeah,
talk about
really.
lack of independence
Yeah,
right there.
right.
Where, oh, what is your
Well, let me see
contract
the purchase
price?
contract,
I mean,
right? Yeah, because they say it because they want to see whether there are normal conditions. Is there anything special? So they want to. But
Well,
again,
that's fair, but just don't tell them the amount.
because we're
Yes, exactly.
because we're private lenders are not bankers in the sense that I don't want them to agree necessarily with everybody else involved in the transaction. I really want to know what the value of that property is, so that in the event, independently, in the event I need to foreclose on that property because the guy doesn't make those loan payments, I want to know what I'm going to get for it. I don't want to just paper the file so that it looks hunky dory and check off all the boxes. Because I'm not packaging my loans to sell them to some third party. I'm not selling them
That's a
to
good point.
Fannie Mae or Freddie Mac. So I'm not trying to paper the file. And again, this is not to disparage banks and what they do, because
That's okay. They can disperse themselves.
they're producing these investment products called promissory notes, which are basically consumer home loans, and they want to package them up and they want to have them comply with certain rules and regulations so that they can put them together in a pool and then sell them off in the form of bonds. Well, hard money loans are, we use private investor capital. We're using people's retirement funds. So we're not going to sell these loans off. In fact, the investors who fund these loans, they don't want to sell the loan. They want to enjoy the 8 to 10% return on their capital that they're getting for funding, these short-term loans to real estate investors. And so when it comes to an appraisal, I'll take the appraisal that you've already got, but we will review it. We will look for something that doesn't look quite right. We will do our own independent evaluation. We have the MLS. We'll pull up the MLS records. We'll look at Zillow. We'll look at a number of different things, looking for something that doesn't quite look right. But at the end of the day, we can use if you paid $500 for an appraisal and the appraiser is known to us, which many of them are, then that's perfectly fine. We can take that.
So it sounds like right now the law is you don't actually, currently, you're not required to even have an appraisal for hard money.
For a hard money loan that is a business or investment purpose on residential property, not a consumer loan or consumer purpose, as long as it's a business or investment purpose, at least today, I am not required to order an appraisal. Now, I am required as a DRE licensed broker to fill out a form and put valuation information in there. How did I arrive at this presumed value? And so we in those cases, we'll do our own comps and produce a little, like a broker price opinion, also called a BPO, for the file, because we are audited by the Department of Real Estate, and they will look for valuation information. So we are required to have valuation information in the file, but we're not required to order
And
an independent appraisal.
when you say consumer loans, you're really talking personal residence.
Well,
Is that kind of another-
mostly, although Dodd-Frank really did something to change the way loans are viewed now, and this is with respect
That's
to
the
resident.
statement of the year.
Yeah, so on residential 1 through 4 units, we're talking about residential 1 through 4 units. If it's your primary residence, then by definition it's a consumer loan. But what if you own rental property and you want to borrow from that equity to pay down your credit card debt, or to put a child through college, or to pay for a child's wedding? That's, even though you're borrowing from an investment property, that's still a consumer purpose. And so they have new guidelines now on consumer purpose. What are you using the money for? So even if you're borrowing it from an investment property, if it's for a consumer purpose, we have different guidelines that we must adhere to, and we have to disclose it differently. There's a 7-day rescission period that's mandatory. So there's a number of things that as hard money lenders we have to do differently based on the use of the funds. So that's something that's brand spanking new in the last few years. Thank you to Dodd-Frank, or Franken-Dodd, as we used to call it.
And Robert, before we get into your email, because I want to spend some time on that, because you do mostly home loans, and it also has to do with appraisals. So we're going to get into yours after the break. But Mark, you also have a fund right now where people can invest, earning.
And so if you were listening to my answer and you heard me say how our private lender clients are earning anywhere from 8 to 10%, we have a mortgage pool fund for passive investors, and it's open to accredited investors, which means you have to have a net worth of $1 million or more, not including your primary residence. That's a new twist to it. But if you're an accredited investor and you're looking for a passive way to earn 8% or more using your savings or self-directed IRA accounts, the Pacific Private Money Fund paid in the third quarter an annualized return of 8.9%. Now, of course, the future is or past performance is no guarantee of future results, but we make our loan portfolio and incoming loan volume is very, very consistent at Pacific Private Money.
And what I like best about that, it's 8.9%, but here's the deal. The average loan in the portfolio, the LTV, loan to value, is only 55%. So it's not like it's 90%. It's not this real risky portfolio.
It's a conservative mortgage-backed fund.
It's something you point out that it's still withheld. All the investments are held with you guys still after after the deals are funded. So there's less fees involved. It seems like you may not have to have an appraisal fee. If you were packaging these mortgages off and selling them, there would be more fees in there. So you actually don't realize how much more you're actually keeping in the fund and
you could basically be more competitive closer to a bank because of the fact that you don't have all these extemporaneous fees that the borrower would have to pay.
It's a one-stop shop. You actually feel good in the sense that you're dealing with the end user, the end product. You know the answers from point A to point Z. You don't know you actually know what happens to these mortgages after the deal's funded. They actually stay with you. And you're the decision maker. Yes.
Right, so it's like a private money bank, Pacific Private Money Fund, and there's only two assets in the fund. It's either cash or it's a promissory note secured by mostly Bay Area real estate at 70% loan to value or less. And again, the weighted average LTV today is 55% in the fund. And
Love it.
We've got a lot of very low LTV loans in the fund. So
I like it. I
Check
have
it
some
out.
of my IRA money with them. Okay, we're going to cut to our third and final commercial break. Trivia question. Let's see if Catherine can go 3 for 3 on this one. What is Ralph's social security number? No, I'm just kidding. I saw the look on that one. Okay, again, the theme is the movie A Christmas Story. What was the name of the radio show Ralph loved to listen to that helped him decode the message about Ovaltine? Ovaltine being the answer. Or drink your Ovaltine, something like that. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Remember, he'd come home every day from school and he'd turn on the radio. What was that program he listened to? So the first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In the movie A Christmas Story, what was the name of the radio show that Ralph loved to listen to that helped him decode the message about Ovaltine? Make sure to include your name, your email address. Speak slowly, spell out your email 1 letter at a time. Don't touch that dial because when the Best of Investing comes right back, we're going to have some closing comments. Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, Catherine Harris, and Robert Schiff. When we got to the third commercial break, we asked this trivia question again. The theme is the movie A Christmas Story. What was the name of the radio show Ralph loved to listen to that helped him decode the message about Ovaltine?
well, that'd be the Best of Investing.
That would not be the Best of Investing.
We're celebrating our 50th anniversary.
yeah, exactly. Catherine, what's the answer?
I have no clue.
Oh no, are they going to be 3 for 3? Does anyone know?
No.
Little Orphan Annie.
Oh, good God. Really?
Yeah, you have to listen to this. You have to watch the. How'd you know the other stuff about the glow lamp?
I think I see parts of the movie.
Oh, I never the whole thing. in
Exactly.
one shot.
Yes.
Okay. We do have an email here for Robert that was kind of along the same lines with Mark here. It says, why won't the bank use the, and this was an angry one, why won't the bank use the appraisal I just got on my own to see how much my house was worth, to see if it made sense to refinance? So it sounds like this guy, what he did was he said, you know what, I don't know if it makes sense to refinance, I don't know if my house will appraise enough, so he went out and bought his own appraisal. And then he says, I want to use this appraisal, I don't want to pay for another one.
Unlike the hard money loans, the Dodd-Frank regulations that mortgage banks or mortgage brokers are required to stay under are much more difficult and rigorous. And anytime you get a loan on a property, the bank that you're getting the loan from has to originate the appraisal. When one of the problems that caused so much
Dismay and
dismay
chagrin.
was that appraisers were appraising properties as they were being told to and not as the market was. So a bank would go, in fact there were some stories in Florida where guys were doing appraisals and it's condos and there was big walls and the condos, there was nothing behind there. So literally empty space.
Wow.
So
What does RPM mortgage require?
they require that if you're going to get a loan from RPM Mortgage, RPM has an appraisal company affiliated with them, and that appraisal company does the appraisal. In the past, if somebody came to me to do a loan, I could go to my friends or the appraisers I knew were reputable and have them do the appraisal. Now it has to be blind. If a loan comes to my bank, or it's true for any bank, they have an affiliation with an appraisal company. The bank goes to the appraisal company and says, will you please do the appraisal? The bank can't ask for any specific appraiser or anybody. They can't ask anything. They can't have any input into the appraiser's appraisal for that property.
So that's an appraisal ordering service. I mean, that company you call doesn't even do the appraisal. It's a new industry that's sprouted up.
It's a total new
servicing
industry that's
company
sprouted
that-
up, and all the appraisers then, when they were independent, now they had to go to these appraisal companies and get registered with the appraisal companies. And the outcome is, for the hypothetical security in the business, the client pays more than they did before, because now they pay a company and the company takes a percentage
Right,
of
the
the
appraisal
proceeds,
management company,
and
yeah.
the appraisers make less than they did. So the outcome is the clients pay more and the appraisers get less.
And there's someone skinning off the
There's
top.
a middleman
It's
now.
a little bit-
Yeah.
So the fact is, even if that person hadn't gotten their own appraisal, but they went to a credit union or a bank whose name I won't name because I've seen it happen a lot. If you go to RPM or most banks, the only out-of-pocket expense you'll have during the process would be the appraisal.
There. Okay, we got to cut out here. Here's our thoughts for the day. Rodney Dangerfield said, I could tell my parents hated me. My bath toys were a toaster and a radio. And Bill Cosby said, a word to the wise ain't necessary. It's the stupid ones that need the advice. That's words of wisdom there, too. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.